With that, it's always a pleasure to introduce Dr. Don Hamson. Don's the founder and managing director of Plato. The press call him the protector of the pensioner. I prefer to call him the Justin Bieber of the Blue Rinse set. Please make him feel welcome, Don Hamson.
Thank you, Mark. And welcome everyone. It's great to be here in person, to be able to see people as I'm presenting. I am so sick of, looking at my computer screen and doing a presentation to 200 people and having no idea whether they're paying attention, they're asleep, they've completely lost me or whatever it might be. So it's a pleasure to have a full room and a full house. We had the same in Brisbane and the same in Gold Coast. Before I get into my presentation though, I just do want to reflect on that Are You OK? Coming back from Brisbane yesterday, I was in the Virgin Lounge waiting for my flight. And there were a couple of, he wasn't a legend, but he's a semi-legend, a rugby league player, another guy I didn't know, and they were just chatting about Paul Green, and I heard the word, he hit it well. So the problem is you don't even know if some person's not okay sometimes, so that's one of the issues. But also from my own personal experience though, because some of you know, most of you don't know, but I've had my own tough time in the last couple of years, not on top of COVID, that you can be very much down in the dumps, but it is fantastic if someone does either, whether they say it to you, whether they give you a call, or even they text you and just say, are you okay, how are you going? It makes a big difference that other people out there are actually thinking about you and they're not going through this completely by yourself. So I would definitely say, ask, are you okay? Even if you think things are fine, people aren't going to chastise you for doing it. So, the Great Reshape. Well, I actually think, yes, some things are changing, but the reality is some, in fact, many are remaining the same. And to some extent, the things that are changing back to what's happened before, because we've had a fairly unique period the last 10 or 12 years. The all-important disclaimer, I'm assuming you've seen many of these before. Don't trust me because I'm a doctor. Don't choke on we haven't got chicken today. The first day of this week, I haven't had chicken for lunch, so... we've got red meat and red meat. How do you get that? Or white red meat or red meat. So anyway, if I'd been doing this presentation at the start of this year, I'd said interest rates are going to stay low till next year. That's what the RBA is saying. That's what Phil Lowe is saying. Even in February, he was at a press club presentation, which I watched over TV, and it was only when he was pressed by someone on questions, he said, we might raise interest rates in the second half of this year. Well, that has certainly changed, hasn't it? So things have changed. But they've changed back to what we've always had, which is a cycle. We now have interest rates going up. We haven't seen them going up for 11 years. So, if you've joined the investment industry in the last 11 years, this is the first time you've seen interest rates going up. So you might go, wow, this is unusual. But for those of us with a few grey hairs, or all grey hairs in my case, I am for the blue set sort of things, but I'm not going to dye my hair blue or purple. We haven't really seen interest rates rise very much at all. And in fact, interesting note, if interest rates get to the high threes, Bill Evans from Westpac's is forecasting 3.6 at the moment, but he's ratcheted his number up a couple of notches in the last few months. If it gets to 3.6, this will be the most aggressive tightening by the RBA ever. This chart is the history of the RBA cash rate. They only started affecting the overnight rate in 1990, and the tightening this time around, if it goes to plan or to forecast, will be larger than the tightening in 1994. And I actually think the current environment is very similar to 1994, which is when global interest rates went up, inflation was rising, the Fed and others wanted to crack down on inflation, bond yields sold off, and we had negative returns on bonds and we had negative returns on equity. And that's just what we've had in the last 6 months or the last 8 months has been exactly the same. So very similar to me to 1994. But bang, worse than 1994, you see inflation did rise in 1994, but it actually only got to about 5%. We're actually already cracked through that here in Australia at 6%. It's 10% in the UK, it's 8% in the US. So we're seeing 30-year highs or 30-plus year highs in inflation, forgetting that GST effect we had when the GST came off. That was a once-on sort of big change in inflation, but that was just because of the GST. So, but we've been there before. This is not new, it's called history, economic history. So we've had these cycles and it is pretty significant. But for income investors, it is very significant because if you are, particularly if you're a very safe person and you've still got your money in term deposits, and I'd say normal term deposits at a big four bank or what have you, you are going backwards big time. I get these numbers from the RBA, and it's still got a 1 in front of it for a 1-year term deposit the last time I read this sort of stuff. And so if you're looking at 6% inflation and you're only getting 1 or 2% on your term deposit, you're going back 4 to 5%. Or if you had $1 million, you're actually losing in real terms after inflation $40,000 to $50,000. And we've never seen that ever before because back in the 80s, interest rates were double digit. And yes, inflation was double digit, but actually interest rates were higher. And so you still got a positive real return. And my parents had fantastic returns off cash in the 80s. But the poor pensioners or, in fact, self-funded retirees, if they're in those very safe assets, are going backwards big time. And what does that mean? Well, this is stylised, but it's actually based on real assumptions. I've said, let's have a couple with $1 million, which generally most people think is $1 million to invest on top of their home, retire at 65, own their own home. They want to ask for comfortable lifestyle. And if they're investing at minus 5% real, which is what they're really getting now on that safe asset, that black line is the balance of their retirement. And it's going to go down. Now, it actually does last till 83. And you say, well, that's pretty good because that's about life expectancy. But the reality is that one of those couples is probably going to live, at least one of them is probably going to live well into their 90s or longer. The other thing is, the reason it lasts so long is because you start drawing on the pension. You actually would get that couple, if they had a minus 5% real rate of return, they'd be getting the full pension at age 72. And I can't imagine too many retirees retiring with $1 million expect to be on the full pension at age 72. Within 7 years, they're actually got to draw on that pension and live off it. So to me, I think that's quite challenging, and safe assets are losing you a lot of money. However, if you just get a zero rate of return, zero real return, it's better, gets you to 78 before you're drawing on the full pension. But even just as 3% real return, you're looking pretty good. So I'd still say you need your money in a balanced fund, not in those safe assets. There is obviously a lot of uncertainty at the moment, though. A lot of doom and gloom, and I've already heard some here, and you'll probably hear a little more. You might even hear about blood on the streets, but apart from Ukraine, I think it might be a bit of an overestimate. But we obviously have rapidly rising interest rates. We've got rapidly rising inflation. We've seen 4 rate rises in 4 months, or technically almost 3 months. There is a war. There are supply side problems in China and what have you. We've got problems in the South China Sea. House prices are falling, particularly here in Sydney, but also in Melbourne. I already mentioned it, bonds and equities sold off, and we just went through the 3rd worst financial year for super fund returns ever. I think 94 was probably one of the other one in there too. That is the glass half empty. But on the other side of things, we have full employment. There are more jobs than there are seekers, and the same in the US. So that everyone's got a job. I mean, we've got a job summit, try and find 1 million people. Despite the fact that interest rates are going up, they are still as low, in a relative sense, as low as most people have seen them. Apart from the aberration of the last couple of years. And even if they are going up, particularly on the corporate side, corporate balance sheets are largely very, very solid and conservative. I'll talk about it, give you an example in a minute. And one of my guys said, you can't say that. You can't say that, Australia's well placed for the war, but the reality is some Australian companies are actually making a mint out of this war because, our gas, our LNG exporters are making a lot of money. Our coal stocks are making a lot of money. Grain Corp's making a lot of money. It's going to be a record year. Grain prices are up because Ukraine is also one of the largest exporters, I think second biggest exporter of grain in the world, not going to do too much this year. House prices are falling, but they're actually well above pre-COVID levels. So if you bought your house 3 years ago, 4 years ago, etc., you're laughing. Maybe if you bought it in the last 12 months, not so. But often if you've sold to buy, 6 one after the other. And many borrowers are well ahead on their repayments. We've got massive amounts in offset accounts, or almost record amounts. And yes, we've just had the 3rd worst year for financial assets or for super. That followed the 2nd best ever year. So you average them out and it's probably about normal. So, the media like to beat all this stuff up. So do some teenagers, by the way. What remains the same? Franking credits. And I'd like to say that I did my little bit in terms of educating the population on the benefits of franking credits a couple of years ago. The ALP threw that policy out. It's unlikely to change. Franking credits are still very valuable for retirees. For every $1 of fully franked dividend, you get 43 cents worth of franking credits. So that's very important. That has remained, so I'm not going to go through it. And that means that things like buybacks. We had a record year for buybacks last year. We distributed 15% out of the Plato Australian Shares Income Fund last year, largely because there were 6 large buybacks, including the one by Westpac. That Westpac buyback was worth 12% for a tax-exempt investor, which is a retiree with less than $1.7 million in their super. There were 6 others for the year. This one was actually very good because it was only worth 12%, say only worth 12%. 12% is a pretty good return. But it wasn't very good for any other investors. So basically, we didn't get scale back. We got everything we tipped in got accepted. And so we made quite a lot of money for our retirees in that one. Our process remains the same, but our process is very active. We go, we rotate, we move to where the dividends are. And at the moment, had some examples before, but coal stocks and energy stocks, Woodside, great divvy yesterday. Trying to lose track here with travelling every day. But there's some great dividends coming out there. We move to where those are, and that remains the same. Example. One example which hasn't come up, but and this is a mea culpa. On a couple of presentations I did last year, I said, last year BHP probably it was as good as it gets. It wasn't going to, it was probably the top of the cycle, and they weren't going to make more money, and they're probably going to cut their dividends. So I got it wrong. Iron ore did fall back, and their EBITDA from iron ore fell 17%. But the standout bit for BHP last year was coal. In the previous year, BHP made about $300 million out of coal. Last year, BHP made $9.5 billion. That's EBITDA out of coal. That is a huge amount of money. And basically, the costs are fixed, price went up dramatically, and there's more than $9 billion. That more than offset all the losses from iron ore. It also more than offset the fact that during the year it sold the assets, the oil and gas assets, to Woodside. So the $22 billion profit for BHP in the year that's just gone by, about that much less than its record profit in 2011. It is sold off South 32 and it's now sold off Woodside. So I reckon that's a great result. And it was actually the biggest full year dividend that's ever paid, $3.25 US, fully franked. It's trading on a double-digit grossed up yield. But one of the important things, and I talked about it before, about balance sheets are strong. At the end of the year, BHP has $300 million worth of debt. It'll make that up in about a week. So, and hence, it's making an opportunistic bid for Oz Minerals, which was rejected because it's got an incredibly strong balance sheet. And a lot of companies in Australia are like that. So that's one of our highlights from the reporting season. Another one, and if you've seen my presentation before, you will have seen these slides. I'm not going to go through them in detail because I'm probably about time. Mark's giving the roll-up. What I do want to point out is, though, that for a start, so this is the income you generate if you put $100,000 into shares 40 years ago, in fact 42 years ago. You see a growing income stream, the blue line. You see a very big dip in the pandemic year when a lot of companies cut their dividends, and a big bounce back last year, and it's even bigger this year, so you're going to have a record year. In fact, there was a headline, I forgot to bring the paper, but there was a headline on the weekend said, massive dividends, $100 billion payout of dividends. If you add the franking in, it's $140 billion. BHP, by the way, is $33 billion of the $140 billion by itself. One thing to note, 1994, I said it's very similar to 1994. Well, actually, dividends kept rising after that. I'm not saying it's going to happen this time, but that's what happened that time. The other one is the capital value. You can actually see there was a fall in the capital value, as we've seen this year, in 1994. It wasn't huge, but when you combine it with a fall in bond values as well, it meant a bad year for funds, but it kept rising afterwards. And I just want to leave that with you. The other thing, one very last thing is, if If you look at the outlook for dividends, we've been showing this chart for the last couple of years. You can clearly see the pandemic was, set the bar for the worst year for dividends and the big cuts we saw in 2020. Then things actually became very good and there was a below average probability of stocks cutting their dividends because things were really, really good coming out of the pandemic. Despite all the uncertainty, that probability is only just above average. So actually the level of uncertainty is nowhere near like the GFC or the pandemic based on our statistical model, which is a bottom-up model, looks at all the dividend payers in Australia and looks at the probability they will cut their next dividend. So to me that says a signal that dividends are still well underpinned in Australia. I will leave it there because Mark's going to kick me off if I don't stop.
Thanks, Don.
Thanks, everybody.